Good morning. Welcome to America First Wealth Management Investment Outlook for October 14th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. Joining me today, once again, is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Next slide, Mike. So this is our standard disclaimer. We're not giving any investment advice here. And the opinions are as of October 14th and are subject to change without notice. And you can read this in more detail, but this is our standard disclaimer. Next slide, Mike. So what we like to do every week is to begin with our conclusions, our outlook first, and then extensive detail and data that follows. So after taking a close look at the third quarter earnings, which are about to take center stage this week, Friday's results that we saw by BlackRock, JP Morgan, and Wells Fargo were quite strong. And in fact, they were all above consensus in earnings, and only Wells Fargo was short on the revenues. But it did appear that these financial institutions weathered the rise in interest rates and inverted yield curve quite well. So, and we think it might be a harbinger better than consensus expectations ahead as the earnings season kicks into high gear this week. When we look at the S&P index, year-over-year earnings growth looks to be above 7% for the third quarter, and 50 companies in the S&P have already issued positive earnings per share guidance for the third quarter. So that the earnings information does seem to be quite positive. So we'll be watching that closely. And while we were in the final stretches of the presidential election, some interesting data we noted was that historically, if you look at market performance in the 4 weeks leading up to the presidential election, it's actually been less extreme and duller than the 4 weeks during non-presidential election years. So we thought that was quite interesting. So the rhetoric may be quite heated, but the market action may be a little bit more muted. The third final point we want to make this week is that the current bull market is now 2 years old, and the average bull market run is 5.5 years. So we're just under, we're still less than halfway there versus the average bull market. So this bull market could have a few more years to run. The key macro data points this week are towards the end of the week. Thursday will be retail sales, and Friday building permits. Next slide, Mike. So this is a slide that shows the data that I mentioned, the 4-week performance of the S&P 500, the 4 weeks leading up to election day during presidential years, which averaged 0.82%, and during non-presidential years is 1.89. So that's kind of hard to believe, but that's what the data shows. So don't be upset if the market results are quite boring for the next few weeks up to the election. Next slide, Mike. And this is a table showing the average bull market cycle, average years, average is 5.5 years, median is 5 years. So this current bull market started in October of 2 years ago. So the data does suggest we have a lot more time to run. And notably, the average bull market lasts 5.5 years and gaining 181%. So, and we're up 61% during the cycle. So if we're tracking the averages, the markets still have a lot longer to run if this bull market adheres to previous averages. Next slide, Mike. Turning to weekly market stats, all the equity indices were up positive this week, led by NASDAQ 100. Tech had a strong rally this week, and all other equities did well. MSCI EFA international stocks was down slightly. And the 10-year bond yield did back up about 10 basis points for the week. So the core U.S. aggregate bond ETF was down 46 basis points. So, but for the most part, the week, month to date, and quarter to date, and year to date, all the equity major averages are solidly in the black. Next slide, Mike. Turning to the S&P chart, we're still trending positive. We're kind of bumping up along that 10-day moving average. The RSI at the bottom is a little extended, but not necessarily in the overbought region here. So hopefully we'll continue to trend upwards as we move through the earnings season. Next slide, Mike. Turning to the 10-year Treasury yield, ended the week at last week 4.08, up 10 basis points from the prior week, and now up 20 basis points year to date. So despite the large 50 basis point Fed funds rate cut, the longer end of the curve has backed up in yield and sold off since the Fed hike. So, and now a number of market pundits are beginning to think that the November Fed meeting will probably see a skip versus any action. And I'm sure Mike will comment on that further. Next slide, Mike. This is the yield curve. The yellow is end of December 2023. The most recent on Friday is the blue. The purple is the prior week, and the orange on top is the end of the second quarter. So you can see the dramatic shift in the yield curve. Big rise from the beginning of the year, and now yield curve is starting to come back. Still inverted, but as I've mentioned before, from 3-year to 30-year, it's starting to take a normal shaped curve. All that remains is the short end to drop or the long end to rise. So one way or another, we will return to a positive sloping yield curve by hook or by crook. Anyway, next slide. This is a 10-2-year spread. We did have a big drop in the prior week in the spread, but it turned around this week. So the spread continues to widen. And I'm sure Mike will talk about that. And I'm going to turn it over to Mike here so he can talk about his section.
Thanks, Dan. Well, what I'm seeing is that the economy is strong, and inflation that has been declining is now stabilizing. And in response to these two main points, it's not surprising that the TLT has weakened further. So if you look at the economy, the Fed own model, GDP now, is running at 3.2%. That is very, very strong. And yeah, we have an increase in the initial unemployment claims, but this is mainly due to the hurricane Helen, and as you can see previously in Katrina, the claims went up sharply. So this is not a sign of economic weakness. And if you look at the inflation number closely, you will see that although the overall number has declined, but the core, that means CPI excluding food and energy, has started to make a U-turn. And the Fed in the past had talked about, something called the super core CPI, and this is rising. So I wonder if they will still focus on supercore now that this is turning against the expectation, or would they skip the November meeting? And if you believe in the regression, you would accept that the Purchasing Managers Index input price component has a very good correlation with the CPI year on year, and the PMI leads the CPI by 6 months. So this has started to turn up, and with the Fed cut recently, well, that's going to add more uh, firepower to push up the CPI year on year. And when we look at the minutes of the meeting, the jumbo cut was actually not a decisive initiative. There were a lot of discussion, and here you can see that a lot of the FOMC voting members will be okay with a 25 basis cut. Okay? And because of that, the market has started to back off the very aggressive expectation of further cuts. And now we are looking at less than 50 basis of rate reduction. And this means that 25 in November, 25 in December. So if the Fed were to skip November, then this would back up further. And question then is, how would this affect the rest of the bond market? And to people who had bought the TLT, the very moment the Fed cut rate, I feel bad for them because up to the recent Friday, they would have lost 8 points, right? It's very difficult to explain to people why is it that when the Fed cut rate, one can lose so much money in the bond market. Well, that's because the TLT is made up of the bonds between 20 to 30 years maturity, and that long end of the curve is more concerned with inflation and supply, right? So it does make sense that with the economy so strong and inflation is not going down anymore, uh, Fed very aggressive rate cut, it does make sense that the investors, the bond market is fearful that inflation would come back again in the midst of a lot of supply. And the dollar has recovered because of the Middle East problem there, and into this coming week, it'll be interesting to see whether it will break above the 200-day moving average. And meanwhile, gold seems to be trading within this channel here. And again, it'll be interesting to see this coming week whether it will break out of the channel. If so, then people will be expecting it to hit 2,700. And the question then is, at what point will the market signal inflation coming back rather than just the central bank buying? Dan, back to you.
Okay, turning back to stocks, we continue with a look at the Magnificent Seven, which we've been tracking for quite some time now, as long as the rest of the markets. And once again, we see some choppy performance among the Magnificent Seven last week. Most notable was Tesla dropping almost 13%, pretty much after they unveiled their new robo-van, which I guess the market did not like by punishing the stock selling off on the news. Not sure if many people are ready to jump into a robo-van or if the product will be ready anytime soon. But anyway, the hype was not rewarded in the stock this week. NVIDIA continued its torrid advance, up 7.9% for the week, and leading the Magnificent Seven, up over 172% year to date. Again, we've noted that the demand for NVIDIA's AI chips and their latest Blackwell chip, incredibly strong demand, and the growth ahead looks very positive. So it continues to be rewarded. Um, and NVIDIA hence still is the leader. But the rest of the group is showing lackluster results. Um, Amazon was the only one that was up over 1% for the week. Um, but it does seem like there are cracks in the Magnificent Seven as a whole, as we've been pointing out for the last several weeks that it's getting choppy in the Magnificent Seven. And next slide, Mike. And even Barron's picked it up on Saturday with their headline, "The Mag 7 is so yesterday." Um, I said it a few weeks ago that it was starting to fail, and Barron's started to note it. I just want to point it out, that headline. It's also good news that if this bull market is to continue, the breadth needs to develop into other stocks besides the Magnificent Seven. So we're starting to see that, and that lends to further bullishness for stocks going ahead. Next slide, Mike. Turning to the sector performance, no surprise, technology was the leading sector, followed by industrials and financials and healthcare. At the bottom, with the backup in rates, utilities gave up some of their gain during the week. Utility stocks are, as you can see, up 28.05%. Still leads surprisingly year to date. Most people will think tech stocks as a sector are the strongest, but actually it's utilities. And then, so just want to point that out. If rates continue to back up, there might be continued sell-off in utilities as investors move into higher risk assets like technology. Next slide, Mike. Turning to the factor performance, which we like to cover, all the because we track these and it helps us to identify areas of the market that when you look at different qualitative and style factors, it helps us to discern where there are leaders and laggards by the types of components that these factors represent. So I'm not going to dwell on these, but uh, our followers are welcome to get a copy of the deck and see the detail on it. We do look at these on a trend basis, so we graph them as well. I think in the future we'll start showing these trends as we see them emerge, and then we can highlight them for our viewers. Okay, next slide. Turning over to commodities. Energy sold off a bit. Well, it's actually a little choppy. Gasoline and crude and Brent were up slightly, but other energy commodities were down. Natural gas was down the most, down 8.3%. Nat gas tends to be the most volatile of the energy commodities. It's always difficult to discern a trend. It can be up or down 10% in a week and still be up 10, 20% on the year. But that's natural gas for you. It's very volatile and there's a lot of trading in the futures there. Turning to the metals, gold was up slightly, but the other uh, silver and the other industrial metals were down for the week. And that's probably a bit on the backs of the dollar strengthening during the week, as Mike noted earlier. Next slide, Mike. Great. Food commodities, cocoa still is leading again, up almost 10% on the week. And drop off in sugar, kind of a mixed bag with agricultural commodities showing some volatility here. They're not all moving up or down in the group. It seems to be split 50-50, which is kind of interesting. And we're not sure what it means for food inflation based on the commodity prices, but it does look like at the supermarket, the food inflation seems to have stabilized. Next slide, Mike. This is the economic calendar. We're just going to flip through this. Monday is Columbus Day holiday. The stock market is open, but bond market is closed and banks are closed. So not much going on Monday. Tuesday we have a couple of auctions, Fed governor speeches, New York Empire State Manufacturing Index. Um, that's a that's an important index to take a look at. It's not necessarily a major one, but you know, do want to mention that it'll be out on Tuesday. Next slide, Mike. Um, Wednesday is usual mortgage applications, export prices, import prices, and crude oil stock changes. And we have a 17-week bill auction there. Next slide, Mike. There's a lot of data. So I'm not going to read through all this. There's a lot of energy inventory. There's fully fed data in the morning. Um, it's a long list. Next slide, Mike. Friday is building permits, which is important for new home construction activity. And we'll see if housing starts and building permits are impacted by the backup in the longer term rates here. And that wraps up the week here. Moving over to S&P 500 company earnings. We start the earnings season again following Friday with the financials. We have more financials on Tuesday. There's no earnings on Monday due to the Columbus Day holiday, but Tuesday, as you can see, Bank of America, Charles Schwab, Citigroup, Goldman Sachs. I'll just name the financials, State Street as well. We've got insurance companies, Progressive, United Health. So Tuesday is a big day in earnings, pre-market and aftermarket with JB Hunt, Omnicom, and United Airlines. And also, followers will note that we've changed the format for the earnings news. We're showing the consensus earnings and the earnings from a year ago and the consensus revenues. So just providing a little more detail and information for our viewers. Next slide. Wednesday, also very busy in earnings. We start moving to, we still have some financials there. Citizens Financial, Morgan Stanley, Synchrony, US Bancorp, Discover, Equifax. There's still a whole lot of financials reporting and kind of a mixed bag with some other stocks as well. Next slide. Thursday, again, a lot of financials. Blackstone, Huntington, KeyCorp, M&T Bank, Marsh & McLennan, Travelers, Truist. So generally the week is all about the financial sector. So expect to see a lot of action there. What's good about financials is they tend to move up and down as a group because they're all impacted by interest rates. But it's all a matter of their execution and their regional differences, and sometimes their mix of business, whether it's investment banking, asset management, mortgages or credit cards. So the mix of business and their regional strengths weigh in terms of how they tend to perform relative to each other. Okay, I'm not going to read the rest, but we do have some we do have some healthcare stocks, Intuitive Surgical. Netflix is an important name to follow. That's a good read on the couch potato consumer behavior. So keep an eye on Netflix as well. Procter & Gamble reports after market on Friday. Be a good lead in to the consumer staples sector, which I believe should have more names reporting in the following week. So that's it for a busy earnings week. Overall, we are optimistic based on the pre-announced earnings increases that were given when companies reported last quarter. And so we remain optimistic that earnings will look a little better, and hopefully that'll carry the market higher. And absent any, obviously, black swan event, we got through the Hurricane Milton okay. So that's a positive. It wasn't as bad as the forecasters were predicting, so I think overall that'll be a positive. There will be plenty of insurance claims. As Mike noted, we should see a spike in unemployment due to the hurricane, but usually that'll be offset by the insurance claims payments. There's just a lot of money that the insurance companies release into the economy down there for payment of claims, so that usually will spark a little boost in portions of the economy down there in terms of construction or replacing home appliances, or just putting money in people's pockets to take care of any needs that they have. So hurricanes, albeit are horrible, they do tend to have a somewhat stimulative effect in the local area that that affects them due to insurance payments. So there may be some regional opportunities because of that. There's also the utility companies and the repair companies that go down there to do a lot of repair. So that tends to um, put money in people's pockets that are doing the work. So that's it for earnings and my commentary for the week. And for those of you who want to get more information, to follow up, to schedule a one-on-one call with us, or to learn more about our products and services, please contact Cleveland Ashley. His numbers and contact information is listed here. And with that, we're going to close out for this week's investment outlook. Look forward to seeing everyone next week. So thanks for tuning in. Mike, anything to close with?
No, and happy Columbus Day.
Take care.
Bye bye.
Bye-bye.